Okay, in this fourth video on capital structure within the perfect market context, we're going to talk about what are referred to as some capital structure fallacies, or some things that we think we know but might not be exactly true. Now let's keep in mind as we're working through this that we are talking about a world that is a perfect capital market. So we have a company that's all equity, has $10 million in sales, an EBIT, has about 10 million in shares, stock's trading for $7.50. It's going to change its capital structure by borrowing 15 million at 8% and then using those proceeds to buy back 2 million shares at $7.50 per share. So if we think about this, what would we expect to happen? If EBIT doesn't change, but yet now we have 2 million less in shares, how does this ultimately change the cash flows to investors? So again, if we have no debt, there's no interest, no taxes, then our earnings per share would be equal to $1 per share. But what happens when we recapitalize? The new debt is going to obligate us to make some payments, right? So it's 1.2 million a year. So as a result, our EBIT is now 8.8 million. So now we have $8.8 million. So earnings per share in this case is going to rise, but it's only going to rise about 10 cents, right? So it's 8.8. Now we have 8 million shares. Earnings per share absolutely rose by 10 cents. But the question is, are investors better off? And the answer is no. Although the expected earnings per share goes up, the risk also goes up. So while earnings per share increases on average, investors are now taking additional risk. So the share price is not going to increase as a result of this transaction. This is just the Modigliani and Miller concept that basically says, look, nothing really changes. The only thing that's changing is the cash flow and who gets the cash flow and how it's distributed throughout. There's another question on dilution, right? An increase in total shares. Sometimes, again, it's argued that issuing equity dilutes ownership, so we should basically use debt financing instead of equity financing. So here we have a company, has no debt, 500 million in shares, trading at 16 bucks. They announced a while back they're going to purchase $1 billion of new planes, and they're going to finance this entirely with new equity. So the current, prior to issue, value of the company, 500 million shares times the $16 per share, we have $8 billion in value for the company. So if we sell 62.5 million new shares, that's the billion we need, that's how much the additional shares will increase. So now we have, before the issue, we had 8 million in existing assets, and after the issue, we have 1,000 in cash and 8,000 again in assets. The shares immediately outstanding prior to the issue were 500, and now they're 562. So what is now the value per share? Again, if you divide the 8,000 by the number of shares, we're still going to have $16 per share. So even though there's more shares, the value of the stock is unchanged. Again, why has it become, or why is it unchanged? It's unchanged because there's no change in the cash flows of the company. So as long as a company sells its new shares at a fair price, there's no gain or loss to shareholders. Any gain or loss associated with the transaction is going to come from the net present value of the investments. And this is essentially, we had talked about this briefly in a previous video. It's what's referred to as the separation theorem. That is, when managers think about buying things, they find good things to buy. That's what adds value to the company, and then they figure out how they're going to pay for it. How they pay for it has no relevance on the value of the asset that they're going to purchase, and ultimately then the value to the firm. So with perfect capital markets, financial transactions neither add nor destroy value. They just represent a repackaging of risk and therefore returns. So essentially what this implies is any financial transaction appears to be a good deal, we should take advantage of. All right, if we see it, what that implies is if it appears to be a good deal, there must be some form of market imperfection that is creating this additional value, if you will, from this particular type of project. So that's the end of the videos on capital structure in a perfect market. The next videos we're going to go on and talk about looking at imperfections. Look at those things that have been avoided in this chapter to discuss how they may ultimately impact the value of the company.